Hey everyone, welcome back to Corporate Decoder, the place where we break down these massive financial reports and figure out what's really going on underneath the surface. Or, as our company might say today, they've got some big impairments and the story is not what it seems. Today we are diving deep into the latest quarterly report from Simulations Plus, a company that helps make drug discovery and development a bit faster and a lot more efficient. They've just released their report for the period ending May 31st, 2025, and there are some pretty interesting numbers in here that tell a complex and somewhat troubling story. Let's start with the big picture on their balance sheet. Looking at the numbers as of May 31st, 2025 compared to August 31st, 2024, we see a few really standout changes. Their total assets have dropped quite a bit from over $96 million down to about 134 comes from goodwill, which fell from nearly $96 million down to about $34 million, $96 million down to about $134 million. A big chunk of that decrease comes from goodwill, which fell from nearly $96 million down to about $134 million. That sounds like a lot of negative news, and we'll get into why that's happening as we go through the report. Now for the income statement, and this is where things get really dramatic. For the 3 months ending May 31st, 2025, the company reported a net loss of almost $67.3 million. That's a massive swing from the same period last year when they actually had a net income of over $3.1 million. And when we look at the 9-month period ending May 31st, 2025, the loss is even bigger at over $64 million compared to a profit of over $9 million in the prior year. SIP's significant loss is largely driven by a huge number under impairments totaling over $77 million across the board. To over $9 million in the prior year, this significant loss is largely driven by a huge number under impairments totaling over $77 million across the board. Yes, you heard that right, impairments. This is a really important concept that means the company has had to write down the value of certain assets because they are no longer worth what they thought. In this filing, the company mentions impairments to goodwill, other intangibles, and even long-lived assets. Specifically for goodwill, they write down over $51 million, impacting units like QSP, software, ALI, MC software, and MC services. They also took impairments on other intangibles like trade names and customer relationships, and on long-lived assets for several of their divisions. This is a clear signal that their past acquisitions or internal valuations are not panning out as expected, and effectively they are admitting that some of their investments have lost significant value. When we look at how they pay their employees, stock-based compensation remains a significant expense. For the 9 months of 2025, it was over $4.8 million. While this is a bit lower than the previous year, it's still a substantial cost, and it shows how much they rely on stock incentives to attract and keep talent. Now let's talk about the money coming in the door. Total revenues for the 3 months ending May 31st, 2025 were just over $20 million, an increase of about 10% compared to the same period last year. The software side of the business grew by 6% and the services side grew by a healthy 17%. The trend looking at the 9-month period revenues are up a solid 20% to over $61 million. This growth is particularly strong in software driven by acquisitions and in services boosted also by that acquisition, but with some headwinds in specific service areas due to market conditions. However, the cost of generating that revenue has also grown significantly. Cost of revenue shot up by 39% for the 3-month period and a massive 69% for the 9-month period. This is outpacing revenue growth in both periods. The increase in software costs is largely due to amortization following recent acquisitions and capitalized software costs. For services, the jump is also tied to acquisitions and a shift in how they categorize certain expenses. This is why gross profit, which is revenue minus the direct cost to generate that revenue, has seen mixed results. For the 3 months, gross profit decreased slightly by 2%, while for the 9 months it remained about flat. The gross margin percentage reflects this pressure, with it dropping from 71% to 64% for the 3-month period, and from 71% to 64% for the 3-month period, and from 71% to 64% for the 3-month period, and from 71% to 59% for the 9-month stretch. This means for every dollar of revenue, they are keeping less as pure profit before other operating expenses. The report points to underperformance in acquired businesses like Proficiency as a key reason for this margin squeeze. On the sales and marketing front, expenses increased by 12% for the 3-month period and a considerable 46% for the 9-month period. A good chunk of this is linked to the acquisitions and increased investment in brand awareness and customer engagement. Interesting, general and administrative expenses actually decreased by 20% for the 3-month period and 15% for the 9-month period. Part of this decrease is due to reclassifying some costs to cost of revenues as part of a reorganization effort and lower bonus expenses. Scaled net loss incomes KTs. So when you put all of that together, the massive impairment charges combined with increased costs are the main reasons for the huge net loss reported. The company is taking a significant hit to its profitability this period, reflecting challenges in integrating new businesses and managing operational costs. Let's shift to cash flow. For the 9 months ended May 31, 2025, net cash provided by operating activities was just under $12.5 million. This is a slight decrease from the prior year's $11.7 million. This is a slight decrease from the prior year's $11.7 million. Despite the significant net loss, the company is still generating positive cash flow from its core operations, which is a good sign. They attribute the slight decrease to changes in accounts receivable and prepaid taxes. In investing activities, cash provided was about $5.4 million for the 9 months of 2025. This was mainly from maturities and sales of investments. For the same period last year, they had a much larger inflow of over $45 million from investing activities. This difference is largely because they used more cash for investments in the prior year. Financing activities show a net outflow of about $1.3 million for the 9 months of 2025. This reflects some final payments related to past acquisitions, offset by proceeds from stock options. In the prior year, the cash used was much higher at over $5.6 million due to dividend payments and earnout payments for acquisitions. Now, about those acquisitions. The company completed the acquisition of Proficiency Holdings in June 2024 for about $100 million in cash. This acquisition significantly expanded their offerings in the drug development cycle, from early protocol stages through clinical research and up to commercialization. The report notes that the integration of Proficiency has contributed to higher revenues, but also increased costs and is a factor in the recent impairments and margin pressures we've discussed. Looking at leadership changes, we see that Dr. Lisa Lavange entered into a new trading plan for stock options and shares. This is fairly common for executives managing their holdings and doesn't necessarily signal anything alarming on its own, but it does show ongoing activity in executive stock transactions. A really interesting part of this report is their discussion on artificial intelligence and machine learning. They use AI in their modeling software for drug discovery and development. However, they highlight significant risks, including flawed algorithms, insufficient data, and potential legal and regulatory challenges. The evolving AI landscape and new regulations like the EU AI Act could create complexities and increase costs. This is a really forward-looking section showing they are aware of both the potential and the pitfalls of this transformative technology. They explicitly state there's no guarantee AI will benefit their business and that legal risks around IP ownership and data privacy are substantial. This acknowledges the uncertainty and potential downsides as they integrate AI into their core products. This section also discusses the risk of reputational and competitive harm if their AI applications are flawed or if their intellectual property related to AI is not protected. It's a candid admission of the challenges in a rapidly advancing technological field. When we look at their customer base, the report mentions that their top 3 customers account for 7.4% and 3% of their total revenue for the 9 months ending May 31, 2025. This indicates a degree of customer concentration. While they've had some strong growth internationally with that segment making up 27% of revenue, that customer concentration can be a risk if any of those major clients were to reduce their business with Simulations Plus. Looking at their business segments, the company operates in software and services. For the period ending May 31st, 2025, the software segment made up 62% of revenue, while services accounted for 38%. This is a fairly common split for companies in this space. However, the services segment experienced a significant drop in gross margin from 44% last year to 29% this year, a clear indicator of the cost pressures we discussed earlier. So what does this all mean for Simulations Plus? Well, the company is clearly in a transition period. grappling with the impact of recent acquisitions and a challenging market. The massive impairments signal that they've overvalued some of their past investments or that the acquired businesses are underperforming significantly. This led to a substantial net loss and pressure on gross margins, particularly in their services segment. On the positive side, they are still growing their revenue and generating positive cash flow from operations, which are crucial fundamentals. Their investment in AI, while carried with it significant risks, also shows ambition to stay at the forefront of the biopharma technology landscape. The biggest concerning trend here is the sharp increase in cost of revenues, that is, outpacing revenue growth and squeezing profitability. The large impairment charges are a stark reminder that acquisitions, especially those that significantly impact goodwill and intangibles, carry inherent risks, and the company is feeling that pain this period. Overall, Simulations Plus is navigating a complex environment. They need to prove they can effectively integrate acquisitions, manage costs, and translate their technological edge in areas like AI into sustainable, profitable growth. The significant impairments this quarter suggest they have some difficult integration and valuation challenges to overcome to get back on a clear growth path. Alright, that's our breakdown of Simulations Plus's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.